Hello and welcome back to Elevate with Purpose. Have you ever wondered how some investors consistently outperform the market, while others struggle to make a profit? What if I told you that the secret to successful investing isn't about timing the market or chasing hot stocks? It's about adopting a disciplined, value-driven approach. Today, we're diving into The Intelligent Investor by Benjamin Graham, the definitive guide to value investing. First published in 1949, this book has stood the test of time and is considered a must-read for anyone serious about building wealth through the stock market. In this video, we'll explore the core principles of the intelligent investor, how to think like a value investor and avoid common pitfalls, the difference between investing and speculating, practical strategies to build a profitable, low-risk portfolio. Let's dive into these timeless lessons and uncover how to become an intelligent investor. The setting: the father of value investing. Benjamin Graham is known as the father of value investing and the mentor of legendary investor Warren Buffett. His philosophy is simple: invest in undervalued companies with strong fundamentals and let time and compounding work in your favor. Graham's approach is about minimizing risk while maximizing returns, a strategy that has proven successful for decades. Lesson 1. The difference between investing and speculating. Graham makes a clear distinction between investing and speculating. Investing is about analyzing a company's fundamentals and buying stocks at a discount to their intrinsic value. Speculating, on the other hand, is about chasing quick profits based on market trends or rumors. For example, buying a stock because you believe the company has strong earnings and growth potential is investing. Buying a stock because it's trending on social media is speculating. Actionable steps. Focus on companies with strong financials such as low debt, consistent earnings, and a competitive advantage. Avoid chasing hot stocks or trying to time the market. Develop a long-term mindset and be patient with your investments. Ask yourself, am I investing or speculating with my current portfolio? How can I shift my focus to long-term, value-driven investments? Lesson 2. Mr. Market and emotional discipline. Graham introduces the concept of Mr. Market, a metaphorical character who offers to buy or sell stocks at different prices every day. Sometimes Mr. Market is optimistic and offers high prices, and other times he's pessimistic and offers low prices. The key lesson? Don't let Mr. Market's mood swings dictate your decisions. Instead, use his irrational behavior to your advantage by buying when prices are low and selling when they're high. Actionable steps. Stay disciplined and avoid emotional decision-making. Take advantage of market downturns to buy quality stocks at a discount. Ignore short-term market fluctuations and focus on long-term value. Ask yourself, how do I react to market volatility? How can I use Mr. Market's mood swings to my advantage? Lesson 3. Margin of safety. One of Graham's most important principles is the margin of safety, the idea of buying stocks at a price significantly below their intrinsic value. This provides a cushion against errors in judgment or unexpected market downturns. For example, if you estimate a stock's intrinsic value to be 100, you might buy it at 70 to ensure a margin of safety. Actionable steps. Learn how to calculate a company's intrinsic value using financial metrics like earnings, cash flow, and book value. Only buy stocks that are trading below their intrinsic value. Aim for a margin of safety of at least 20 to 30%. Ask yourself, how can I calculate the intrinsic value of a stock? What's one stock in my portfolio that has a strong margin of safety? Lesson 4. Diversification and risk management. Graham emphasizes the importance of diversification to reduce risk. By spreading your investments across different industries and asset classes, you can protect your portfolio from significant losses. For example, instead of investing all your money in tech stocks, diversify into healthcare, consumer goods, and real estate. Actionable steps. Build a diversified portfolio with at least 10 to 15 stocks across different sectors. Consider adding bonds or other low-risk assets to balance your portfolio. Regularly review and rebalance your portfolio to maintain diversification. Ask yourself, is my portfolio adequately diversified? How can I reduce risk by spreading my investments across different sectors? Lesson 5. The defensive versus enterprising investor. Graham divides investors into two categories: defensive and enterprising. Defensive investors are passive and prefer low-risk, low-maintenance investments. Enterprising investors are active and willing to put in the time and effort to find undervalued stocks. Graham provides specific strategies for both types of investors, ensuring that anyone can succeed regardless of their experience or time commitment. Actionable steps. Decide whether you're a defensive or enterprising investor based on your goals and availability. Follow Graham's strategies for your investor type, such as index funds for defensive investors or deep value stocks for enterprising investors. Stick to your chosen strategy and avoid switching between approaches. Ask yourself, am I a defensive or enterprising investor? What's one strategy one can adopt based on my investor type? Lesson 6. The importance of patience and discipline. Graham teaches that successful investing requires patience and discipline. The market may fluctuate in the short term, but over time, quality investments will deliver solid returns. For example, Warren Buffett, Graham's most famous student, has built his fortune by patiently holding onto quality stocks for decades. Actionable steps. Avoid checking your portfolio daily. Focus on long-term performance. Resist the urge to sell during market downturns. Stay committed to your investment strategy, even when it feels challenging. Ask yourself, how can I cultivate more patience and discipline in my investing? What's one long-term investment I'm willing to hold on to for years? Lesson 7. The role of intrinsic value. Graham emphasizes the importance of understanding a company's intrinsic value, the true worth of a business based on its fundamentals, not its market price. By focusing on intrinsic value, you can avoid overpaying for stocks and make smarter investment decisions. Actionable steps. Learn how to analyze financial statements to determine a company's intrinsic value. Use metrics like price-to-earnings, P/E ratio, price-to-book, P/B ratio, and dividend yield to evaluate stocks. Compare a stock's market price to its intrinsic value before buying. Ask yourself, how can I calculate the intrinsic value of a stock? What's one stock in my portfolio that's trading below its intrinsic value? Lesson 8. The power of compounding. Graham highlights the power of compounding, the process of earning returns on your returns over time. By reinvesting your earnings and staying invested for the long term, you can grow your wealth exponentially. For example, if you invest $10,000 with an annual return of 1067,000 in 20 years. Actionable steps. Start investing early to take full advantage of compounding. Reinvest dividends and earnings to accelerate growth. Stay invested for the long term and avoid frequent trading. Ask yourself, how can I start taking advantage of compounding today? What's one long-term investment I can commit to? Lesson 9. Avoiding common mistakes. Graham warns against common investing mistakes, such as overconfidence, believing you can predict the market, following the crowd, buying stocks because everyone else is, ignoring fundamentals, investing without analyzing a company's financials. Actionable steps. Stay humble and recognize that no one can predict the market. Do your own research and avoid blindly following trends. Always analyze a company's fundamentals before investing. Ask yourself, what's one investing mistake I've made in the past? How can I avoid making the same mistake in the future? Final thoughts. Become an intelligent investor. The Intelligent Investor is more than just a book. It's a guide to building wealth through disciplined, value-driven investing. By adopting Graham's principles, you can minimize risk, maximize returns, and achieve financial independence. The key takeaways are: invest, don't speculate, focus on companies with strong fundamentals. Use Mr. Market to your advantage, buy low and sell high. Always seek a margin of safety, buy stocks below their intrinsic value. Diversify your portfolio to reduce risk. Choose your investor type, defensive or enterprising, and stick to it. Be patient and disciplined. Let time and compounding work in your favor. Understand intrinsic value and avoid overpaying for stocks. Harness the power of compounding by staying invested for the long term. Avoid common mistakes like overconfidence and following the crowd. If you found this video helpful, Subscribe to Elevate with Purpose for more insights on personal growth, mindset, and financial success. And before you go, let me know in the comments, what's one lesson from The Intelligent Investor that resonated with you? And what's one step you'll take to become a more intelligent investor? Until next time, keep growing, keep learning, and keep elevating your purpose.